As a self-directed investor, think of how many times you've decided to buy a company and your reasoning was this company is too big to fail, or this company isn't going anywhere anytime soon. The barriers to entry are too high. And if you have ever thought this, which I would guess almost 100% of people watching this video have had this thought process before, I'm going to be going over in this video why it is a deep investment flaw that is likely to end up resulting in subpar returns. And there is a very important and uncomfortable truth when it comes to this video you're going to watch, and that is the fact that economic moats are overrated. Not in the fact that they are not valuable, but just in the fact that you are not gaining any sort of market edge by identifying and buying companies solely because they have an economic moat. And I'm going to go over why in depth in this video. And as always, everybody, make sure you subscribe to the channel, like the video, head down below and comment. We just gave away a bunch of free premium subscriptions to our watchers over on the community tab, just because they were subscribed, just because they dropped a comment and they liked the videos. So make sure you do that if you appreciate the content, especially if you want more case studies, market commentary, stock research, things like that. And as always, I got all those free reports in the description. They just take a few seconds to sign up for, and they're absolutely free. But let's get into the video. So what exactly is an economic moat? And an economic moat is a situation where a company has a distinct competitive advantage to the point where its competitors can't really take revenue easily. We can think of an economic moat coming from an actual castle moat. It is something built around the castle that stops enemies from getting in. This is the business infrastructure some company has built that stops competitors from easily taking market share. Now, the idea of owning these companies is very attractive. We can think of a company like Amazon, whose retail distribution network is unmatched and would be very hard to replicate. It would take a company tens, arguably hundreds of billions of dollars worth of infrastructure to build this out, and that is a gigantic risk considering the fact they might not even take market share from Amazon after the build out. An economic moat does not really focus on company execution all that much. It is more so along the lines of the company's potential to be disrupted. So let's go over some very popular economic moats. The first one is intangible assets. So these would be assets that aren't necessarily easy to quantify. They aren't a piece of equipment, but they're instead brand power, intellectual property. The first one I can think of is something like Coca-Cola. The brand is very strong. When we think of intellectual property, we can think of something like Disney. They have all of that IP that they have the exclusive rights to, that only they can make money off of, or if they give somebody else the opportunity to make money off them, they're obviously taking a cut. And then in the third instance, we could have a particular healthcare patent that a single company owns for a particular duration of time, making it the only company to be able to generate revenue from that piece of medication. Second one would be networking effects, and this is a company's ability to effectively make its platform more popular and more valuable the more people use it. So the number one thing I can think of in regards to this would be payment rails, payment processors like MasterCard, Visa. Obviously, their networks are insanely large and almost impossible to replicate. And then we look to a company like Uber, its rideshare platform. As the network grows, ultimately the network becomes more powerful, easier to scale, easier to increase margins. Now, the third one would be switching costs, and this would be one of the more valuable economic moats I would think of today, especially when we look at a tech-based economy. And this is effectively the annoyance or the financial cost it would be for somebody to switch to a different product. Now, when I can think of switching costs, immediately I can think of a product like Office 365. It is deeply ingrained into businesses. And when we think of businesses that have tens of thousands of employees, if you think about the fact that that company might be able to find a cheaper alternative, the overall costs in terms of doing so, in terms of training new employees on the new piece of software, and then factoring in how inefficient they'll be while they learn this new piece of software, that makes these products very sticky. And the other thing I can think of in regards to this would be the Apple ecosystem, the Apple services. Their app store, people own Apples. They have made purchases in the app store, whether it be iTunes, particular apps, things like that. And if they swap to Android, they will lose all those and they'll have to buy them again. This is more on the retail side of things, whereas 365 is more on the enterprise side of things, but it's still viable examples of switching costs. Now, the fourth one would be scale and cost advantages. Again, I've mentioned this before with Amazon. We got that massive distribution network, which ultimately means they can ship goods for cheaper. They can undercut a lot of competitors due to the sheer volume. And also the moat is kind of protected in the way that capital infrastructure is insane to kind of replicate. Another company I can think of, prime case of this, would be the railways. They, the land to buy them, the money it costs to build the tracks, things like this. That side of things creates an outstanding economic moat. And the final one I'll go over would be a regulatory or a build-out moat. So when we think of regulatory, we can probably think of regulated utilities where their earnings are effectively protected by governments and municipalities. That's why they are so consistent and why little competition will ever enter the space. It's just simply too regulated and too expensive. And another regulatory issue I can think of is something like waste disposal companies, landfills. Landfills are extremely hard to build. If you were a competitor looking to build out a landfill, you're likely looking at 10 plus years of regulatory hurdles to get through, and the difficulties of building landfills because nobody wants them in their space whatsoever, which is why a lot of these waste collection companies are valued very highly, often trading at 5 times book value, because those landfills that it bought previously have so much more economic and profit driving impact than they are listed on in the balance sheet, because a lot of them are listed at their historical costs. So now that we've discussed this, let's, kind of boil it down as to why these economic moats really don't matter that much. And I do find a lot of investors' research starts with economic moats, which is a very good thing. You want to be identifying companies that have very little chance of disruption. However, as I mentioned at the start of the video, you are not gaining any sort of edge by identifying and buying companies solely on their economic moats. And the key thing here is, it is because the market knows about the economic moat. If you're a retail investor doing a quick screen on companies that have their business protected by an economic moat, it's safe to say that the broader market already understands what this moat is. It is publicly available information, and it is going to be automatically priced into the stock price. This is why you often see companies that have strong economic moats trade at premium valuations. So you are paying an added premium for that economic moat. Yes, Amazon's retail distribution is unmatched, but everybody knows this. Yes, the landfills that Waste Connections or Waste Management operates, they're very hard to build, almost impossible. Everybody knows this. Microsoft 365, very ingrained software that results in high switching costs. Everybody knows this. You're not gaining any sort of edge or potential outsized returns moving forward solely based off this economic moat. Bulletproof business advantages are just not going to be ignored by the market on a broad scale. And this is actually where the real risk comes in with focusing too much on an economic moat, because you might end up paying too high of a price. We can look to a company like Costco, who, yes, they have the best business flywheel in the world, I would argue, and they have a rock solid economic moat when it comes to consumer staple and even to an extent consumer discretionary purchases. But everybody knows this. And last year, Costco ran up in price a lot. And if you bought this company solely off of its ability to do what it does, you paid 60x earnings for this company, and it's kind of gone nowhere over the last year or so. You weren't gaining any sort of edge buying Costco because of the flywheel, because of the high membership renewals, because of the consistent, foot traffic that was increasing in the stores. Why? Because the market knew this. Moats are very important from a reliability and a stability perception. However, they are not really all that important when you're speaking on future expected returns. Just because a company has a moat right now does not mean that you haven't paid a price too high to justify any sort of meaningful returns in the future. In fact, I see this all the time. The market is very, very good at pricing in this stability into the company's stock price. And if you're looking at the moat as a reason to buy, as the sole reason, the core reason to buy, you're likely going to end up overpaying for a lot of companies. So they are a starting point and they aren't the finish line. And the reasoning behind this is there is always the ability for management to absolutely butcher any sort of economic moat a company has. And it has happened numerous times in the past. And I'm going to go over some examples, and you might sit back here and be like, oh, well, that was obvious. That was obvious. But it really wasn't. Back when these companies were dominant, they truly were dominant, and there was not a lot of forward thinking in terms of adaptability from the company's management to continue to execute on the moat it has. Instead, a lot of investors just ended up paying a premium valuation. These companies lost their edge and they ended up getting destroyed. So let's go over the first one, and this is in recent times, and that would be Disney. And this was a company I actually did own, but ended up moving on because of some very bad management decisions that ultimately eroded any sort of moat the company had. I mean, I would argue they still have a moat, but poor financial results have resulted in it not doing well over the last while. The company owns so much intellectual property that the market valued it very high due to its ability to generate a ton of free cash flow from that IP. The difficulty here is management not only botched that process so badly, they had to overhaul their CEO, but consumer sentiment has shifted as well. We have, people spending less at the parks because costs are so high. And then we have Disney Plus, probably one of the biggest mistakes of this company for quite some time. I'm not saying Disney Plus is the biggest mistake, but I'm saying the amount of money they dumped into that platform to realize very little profits from it. This is one of the poster boys of a way for a company to absolutely mismanage the assets and the moat it has. So the second one would be BlackBerry. If you remember back in the early mid-2000s, they were never going to be disrupted. And then Apple came out with, Apple and Android touchscreen technology, kind of an app-based system. And BlackBerry easily could have saw this coming. They easily could have tried to capture this segment of the market and adapt, but really all they did was stick to what they were doing. And ultimately, BlackBerry's collapsed in value. Very poor capital allocation situations from BlackBerry, very poor management decisions that ultimately ended up in one of the biggest smartphone producers in the world, just getting absolutely crushed. So another one, IBM. This company practically ran a monopoly for the better part of 20 years. It operated with, the world's biggest banks, insurance companies, government bodies. They actually coined a phrase back then. Nobody got fired for buying IBM. And what they effectively meant by this is if you were a company and you were trying to develop some sort of new piece, new system, new product, new development, things like that. If the product ended up failing or running way over budget, as long as you bought IBM, generally, you'd be fine. Your job would be fine. But if you had went to a similar competitor or a smaller competitor trying to develop a new product and you ended up buying that and it failed, generally your job would be in trouble. So that is how ingrained IBM was in so many systems, so many companies. And back then, the company had enough cash flow to adapt and overcome any issues it would have faced. However, it just kind of sat on its hands while smaller competitors just, we can look no further than the personal computer, the PC, that ended up crushing IBM. Kodak. And this one is very ironic. I'll get to that in a sec, but they had probably the largest distribution of film on the planet. They had a ton of patents, a ton of IP on the chemicals utilized to make film, the development processes of that, their distribution network in terms of how many stores they were in order to get film developed was just unmatched. And the ironic thing here is Kodak was actually one of the first developers of a digital camera. But what did the company do? Well, they were afraid that that digital camera would end up cannibalizing their standard film business. So what they did was they developed this camera and they never ended up releasing it. They never utilized it. And what ended up burying Kodak? Well, it was digital cameras, digital imagery. It just could never adapt, and severe management missteps actually ended up in this moat just being absolutely killed. And the final example would be BCE. Now, I would argue that the moat for this company still exists, but this is a prime example of what I would use to kind of highlight the fact that despite an economic moat, you need a strong management team in place. And I would argue that BCE has one of the worst management teams in place in Canada. I would really argue that. Debt levels ballooned. They made some very poor asset sales, very poor acquisitions. They ended up hanging hanging on to a unsustainable dividend for multiple years that ended up just destroying shareholder value. Despite this moat, the company just got killed. So now that we've spoke about the fact that you need to not solely focus on the moat, but instead expand your thinking, what exactly should you be looking at? And one of the main things you do need to be looking at is judging whether the premium valuation is worth it. I mean, the number one thing here to look at is whether or not the moat can be disrupted, because any moat can be disrupted. Don't get the idea that every single moat is safe. Yes, there are some that I would say have a very, very little chance of being disrupted. I mean, railways would be one that I could think of. But when we look to artificial intelligence, there is a lot, and I mean a lot, of potential disruption moving forward. And companies that had very sticky businesses moving forward are facing levels of disruption we've never seen before. I mean, I'll drop a link to the video up above on Constellation Software. It's currently going through one of these situations. Another one I can think of is a company like Adobe. This company had a massive, massive moat on digital development. I mean, we can think of Premiere Pro, we can think of Acrobat, we can think of Photoshop, but now it's currently facing a lot of headwinds in relation to artificial intelligence. Now, on the enterprise side of things, like the business side, large-scale customers, they aren't quite switching yet. Again, we have those switching costs. It gets expensive to train new employees to swap to new systems. But on the smaller side of things, they're seeing churn from smaller businesses that can tend to adapt quicker. So AI is definitely disrupting Adobe's portion of that business. And what do you know? The market has kind of eliminated the premium valuation that Adobe used to command for having that moat. And the other one I would argue is capital allocation and the skill of management. This is arguably one of the more important ones. It's very important to understand that any cash flow or earnings the company generates, as a shareholder, you are entitled to a portion of that cash flow. It is yours. So if the company chooses to spend it unwisely, that is ultimately a detriment to you. A ton of companies can have rock solid economic moats, but spend capital terribly, leading to poor shareholder returns. One of the main examples I would actually use here, and a company that I ended up selling because it frustrated me so much, was CN Rail. So CN Rail has arguably one of the most defendable economic moats in North America. I mean, railway tracks are borderline impossible to build and compete with outside of the companies that have the ability to do so. But that does not stop a company like CN Rail from making very poor decisions, which it ended up doing during the COVID-19 pandemic. We can see this chart here. The company ended up spending more than it was bringing in terms of free cash flow on buybacks and on dividends in a peak freight environment. They were buying back shares at peak prices, and we fast forward to today when the rails are kind of in the gutter, the freight environment is in the gutter, and the company has scaled back buybacks. This is a prime example of a buy high, not necessarily sell low, but the company dumped a bunch of money into buybacks when we were in like global lockdowns. Freight was through the roof. E-commerce was through the roof. Management went and spent a boatload of money buying back shares when in reality they should be buying them back now. And you can look to a company like CP Rail who has done the opposite. They stopped buybacks during the pandemic, primarily because of an acquisition. But now that prices have got more attractive, they've started buying back shares again. So this type of capital allocation is absolutely key. You need a management team that can generate profits from the moat it has. Just having that moat is not good enough. You are paying a premium valuation to hold companies like this, so you'd better make sure that the management team has systems in place to either expand that moat or grow profits based off the moat they already have. So wrapping it all up, the one thing I wanted to highlight, the key point I wanted to drive home in this video is you are not gaining any sort of investment edge from investing in companies with economic moats. I see it all the time. It's at the top of the list in terms of, people just kind of blindly say you need to own companies with economic moats. So people think that it's kind of the be all end all when it comes to investing. And a company's moat is, first off, you're paying for it. And secondly, is only as good as a management team's ability to maintain that moat and drive profit growth from that moat. We have seen numerous times in history where companies with, at that time, impenetrable moats, never going to be disrupted, and ended up getting disrupted. And it doesn't necessarily need a cataclysmic failure in terms of the moat, like a company like Kodak down, 90% after it evaporated. Even if a company has slight disruption, I mean, if the index returns 10% a year and you bought a company that returns 2 or 3 because it's made some poor decisions, you're ultimately underperforming. After you have spotted an economic moat, your work has not finished, it has just begun. There are a lot of other factors you need to be looking at. And if your main investment strategy revolves around the idea that a company isn't going anywhere anytime soon, you will likely realize poor returns over the long term. So everybody, that's it for the video. Head down below, like the video, subscribe to the channel, comment. Remember, we are going to be giving away premium subscriptions randomly on the channel. So you're going to want to be subscribed, and you're also just going to want to be subscribed to gain access to some of the best investment research, case studies, stocks, ETFs, things like that in the country. And we'll see you next time for more great Canadian content.